Crowdstrike is a market leader in cybersecurity with a valuation of nearly $200 billion. Investors love the stock, and that's where the problem lies. The stock has become so expensive that I think there's the potential for significant loss exposure ahead. In today's video, I will explain a stock investment strategy for Crowdstrike with an investment horizon of nearly 2 years at 22 months. I will explain the strategy, called a covered call, that generates total income over 22 months of 26% while affording total return potential of 47%. In the event that the stock falls by the conclusion of this 22-month investment strategy, then that income received of 26% serves as a buffer of downside protection, meaning the investment is protected for the first 26% of downside losses. I will answer the question, why not just buy the stock at $190? Well, when you look at what the foreseeable best case of the stock price is in 22 months, the range that I will show you later is between $283 and $293. Again, that's with the stock at $190. In the strategy I will explain in this video, the effective maximum selling price 22 months from now is capped at a maximum $280. The benefit to the strategy is that it also affords that downside protection of 26%. The problem with Crowdstrike is that the stock is now very expensive after having doubled over the past year to its current level of $190. While the share price appreciated 100% over the last year, revenues are only growing at 22% a year, which means that the rate of growth for the share price is 4 times that of the rate of growth for revenues. As I will explain to you shortly, I think there's a very real possibility that at some point over the next 2 years, the stock, currently at $190, could retest $140, which was the previous peak established last fall and served as a ceiling of resistance at that point. When I say the stock is expensive, what do I mean? Well, let's take a look. So with the stock at $190, we'll take a look at Wall Street consensus projections for the next 5 years. The revenue growth rate is expected to be less than in recent years, which was around 30%, and is expected to be 23%, 22%, 22% for each of the next few years. Normally we would look at earnings, though there's a lot of noise in the earnings number, so let's just address that quickly. So on a price to earnings basis, we have an astronomical number in 2027, and extending out to 2031, that price to earnings ratio is 82 times. Again, there's noise in that number and it's not comparable. So what could be comparable? Well, let's take a look at the price to sales ratio. The price to sales ratio for Crowdstrike on 2027 projections is 33 times. That number of 33 times compares with the S&P 500 price to sales of approximately 3.7 times. So yes, Crowdstrike is a premier company in a hot sector, cybersecurity, with great seemingly secular growth prospects ahead, though is it really worth a huge multiple of 33 times versus the S&P 500 3.7 times? There definitely is a premium warranted, but what should that number be? Given the revenue growth rate, I would argue that this price to sales ratio, looking ahead 1 year, so on fiscal 2028 numbers, instead of the current 27 times, should be more like 20 times. 20 times price to sales based on 2028 revenue projections would translate to a share price of $140. $140 is that level I showed you on the previous screen where I said I think the stock has a real chance of retesting that level at some point over the next 2 years. Maybe I'm overly pessimistic. After all, Wall Street analysts are bullish on the stock. Let's take a look at representative target prices for where the stock will be trading over the next 12 months. So target prices are $240, $227, $235, $245, $240, $250, $230, $250, and $235. Whereas I'm more cautious about that downside being $140, Wall Street isn't concerned and thinks the stock is a market leader, demands a premium that's sustainable, and they foresee an average price of about $240 a year from now. When I look at this strategy that I'm about to explain to you, the total return is capped at the equivalent selling price of $280 22 months from now. $280. Keep that in mind, because how would Wall Street price this 1 year from now? Well, my thought is, say the stock has appreciated to the target price of $240. What would Wall Street assume the stock is worth a year out? The best assumption is to apply the revenue growth rate of 22% to the target price of $240, which would translate to a share price a year out of $293. $293 for seemingly a best case adjusted scenario 2 years into the future compares with the strategy effective cap of $280, which is less than a 5% variance. The stock investment strategy that I will explain to you now is called a covered call. For those of you who are familiar with a covered call, you're most likely familiar with the short-term covered call, which is for a time horizon of approximately 1 month. This covered call strategy has an investment horizon of 22 months. There are 3 main benefits associated with extending the covered call horizon beyond 1 year. Number 1, the contractual income received is much greater given the longer time horizon. Number 2, in the event that the stock falls, then that extra income received serves as a material buffer of downside protection. And number 3, for US residents, the investment horizon extends beyond 1 year, meaning the strategy is tax efficient. A covered call consists of buying 100 shares of stock and then selling 1 call option, as 1 call option is equal to 100 shares. With Crowdstrike trading at $190 a share, the investment for a single covered call is $19,000. This means that our clients require portfolio scale for this strategy to be considered. Here's how this strategy functions. So, with Crowdstrike trading at $190 on August 21st, 2026, the strategy requires buying 100 shares at the market price of $190. The second step is to go into the options market, extending out 22 months to June 2028, and to sell a call option at a strike price or maximum selling price of $230 a share. In exchange for capping maximum share price appreciation potential to $230, 22 months in the future, the strategy generates income of $50 per share. Earlier in the video, I talked about the effective selling price for the strategy being $280. That's the sum of the strike price or the maximum selling price of $230 plus this income received of $50 per share. So the effective maximum selling price for the strategy at expiration in 22 months is the sum of $230 plus $50 for $280 set against an initial investment of $190 today. Let's take a look at the strategy return profile over 22 months. In exchange for buying the stock at $190 and selling a call option at $230, the maximum share price appreciation potential is $40. That equals 21.1%. The income received, equal to $50 per share, is equal to hedged income, or covered call income, of 26.3%. Given that the stock does not pay a dividend, the total return potential for the strategy over 22 months is the sum of hedged income, 26.3%, plus the maximum share price appreciation potential of 21.1% for 47.4%. This is the inherent limitation of the strategy. Irrespective of how much higher the stock may be trading in 22 months, the maximum strategy return is 47.4%. If shares of the stock have appreciated more than 47.4%, then this strategy will underperform. However, if the stock appreciates less than 47.4%, then this strategy outperforms in all scenarios. Let's take a look at the scenario where 22 months from now, shares of the stock are unchanged. Well, in that scenario, instead of having a 0% rate of return for just owning the stock, this strategy will deliver a profit of 26.3% from the hedged income. This is before paying our fiduciary financial advisor fee equal to 1% annually of assets under management. With the 22-month investment horizon, the total fee that we would receive is just under 2%. So the strategy net hedged income to clients would be 26.3% less about 2%. In the event that the stock falls by expiration in 22 months, then this hedged income received of 26.3% serves as a buffer of downside protection, meaning that the stock would have to fall more than 26.3% in order for the strategy to lose money. Let's take a look at some numbers for scenario analysis as to where the stock may be trading at expiration in 22 months. So here we have the columns share price, stock return, and hedged return. If 22 months from now, shares of the stock are unchanged at $190, the stock ownership only strategy has a 0% rate of return. However, this hedged strategy from the covered call generates a profit of 26.3%. In the event that the stock falls, let's say it falls 15.8% to $160, this strategy still delivers a profit of 10.5%. If the stock falls all the way down to $140, the stock would lose 26.3% and this strategy breaks even. If the stock falls further, say to $120, then the stock ownership only loss is 36.8% and the hedged loss is 10.5%. On the upside, if the stock rises, call it 26.3% to $240, then the hedged strategy outperforms by delivering a return of 47.4%. As you can see here, this hedged return is capped at 47.4% once the share price exceeds $230. So as the stock appreciation continues, the hedged profit is capped at 47.4%. In absolute terms, the stock ownership only strategy outperforms so long as the stock exceeds $280 by expiration in 2 years. So you can see this is the break-even point, the indifference point in absolute terms. The stock's at 280, it's risen 47.4%, and the hedged return is 47.4%. If the stock continues to rise, the hedged return is capped, the stock return continues to appreciate, and so on to the upside. However, on a risk-adjusted basis, these numbers aren't really comparable because if you own the stock and you're subject to market volatility, a 47.4% return isn't really comparable to a hedged return of 47.4% where you know you have that downside insulation of 26.3%. Let's take a look at seemingly best case scenarios for where the stock may be trading at in 22 months at the conclusion of the covered call investment strategy. The intent of this comparison is to understand whether that capped return potential for the covered call really detracts from the potential return for where the stock may be trading at. In the covered call strategy, the maximum effective selling price in 22 months is $280. That's the sum of the maximum selling price of $230 plus the income received of $50. In comparison, if the stock price just appreciates in line with expected revenue growth over the next 2 years, then taking $190 today and appreciating the stock for 2 years at 22% per annum, the expected revenue growth, translates to a share price in 22 months of $283. The other potential scenario is if you take Wall Street analyst target prices today on a median basis of $240, which is 1 year into the future, and then just apply a revenue growth rate of 22% to that $240 figure, that means another year into the future, which is 24 months from today, would equal an average Wall Street analyst price target of $293. So the net result of this comparison is that seemingly, and anything can happen, that the best case scenario for the stock is probably, I would argue, somewhere between $283 and $293 2 years from now. The covered call strategy, the protected strategy with the additional income, maximizes the effective total selling price of $280. From a risk-adjusted basis, the covered call strategy offers a compelling profile, though obviously anything can happen in the market. These numbers may be understated, maybe the stock underperforms significantly, anything can happen. And that's why it's essential that we construct customized covered call portfolios unique to each client. If you would like to learn more about our Bespoke TFC Capital Financial Advisor service, go to our website at bespoketfc.com. If you would like to see portfolio examples for specific dollar amounts and with different strategies, go to bespoketfc.com/insights and in the top right-hand corner, click Portfolios. Today's video is for educational purposes only and does not constitute investment advice. If you have any questions or comments about the strategy, leave them in the comment section and I will try to respond. Additionally, if you have any thoughts on Crowdstrike, the stock, let me know in the comment section what you think. Do you think the stock is poised to move higher, move lower? What do you think? Thank you for watching, like and subscribe, and hopefully we'll see you in the next video.